Assalamu alaikum. This is the second part of our video on working with financial statement. My name is Dr. Abdul Adamu. This video will show us how to do ratio analysis. In the first part, we talked about standardized financial statement, the issue of common size balance sheet and common size income statement. In this video, we are going to look at ratio analysis. So by ratio analysis, we mean taking set of numbers from the financial statements and forming ratio with them. There are ways of comparing and investigating the relationship between different pieces of financial information. One major problem with ratios is that different people and different sources frequently don't compute them in exactly the same way, and this leads to so many confusion. So if you are using ratio analysis as a tool of analysis, you should be very careful and to document the way you calculate each of them, so that when somebody is comparing ratios, you should know that the basis of computation are the same. So if you are comparing your numbers to those of another, be sure you know how their numbers are computed. So we have basically five types of ratio, five categories of ratio. We have the first one is the short-term solvency or liquidity ratios. Then we have the long-term solvency or financial leverage ratios. We have the asset management or turnover ratios. We have profitability ratios, and we have market value ratios. We'll look at each of them one by one. Then we'll go to our Excel and see how they are computed. Now, the first one is the liquidity ratio. By liquidity ratio, we mean that this ratio provides information about firm's liquidity. And when we talked about liquidity in our first lecture on income statement, we said liquidity the information about liquidity are gotten from current asset and current liability, which are generally termed the working capital. So these ratios focuses on current assets and current liability, current asset and current liability. And one advantage of looking at it is that their book values, the book values for current asset and current liability and the market value are closely similar. So on the other hand, like any type of near cash, current asset and liability can do change fairly rapidly. So today's amount may not be a reliable guide to the future. So the liquidity ratio we are going to consider here, there are three of them. The first one is what we call current ratio. Current ratio is a measure of short-term liquidity, and it is measured as current asset all over current liability. To a creditor, a particularly short-term creditor such as supplier, the higher the current ratio, the better. So since we are dealing with current asset and current liability, if you have current assets that are a bit larger than current liability, then we say the current ratio is a bit good. So to the firm, a high current ratio indicates liquidity, but if it is very high, it shows an inefficient use of cash and other short-term assets. A current ratio of at least 1 is okay for most firms, but a current ratio that is low may not necessarily be a bad sign for a company with a large reserve of untapped borrowing power. So let's look at the another type of liquidity ratio is what we call the quick ratio or acid test ratio. So this, it consider inventory as the most illiquid asset because we have to convert it to finished goods, then sell it to generate account receivable, before they are collected to become cash. So for quick asset ratio, inventory is normally subtracted from the current asset before we divide it by current liability. So some of the inventory may turn out to be damaged or obsolete. That is one of the reasons why we don't use that. So the last one is what we call the cash ratio. So a very short-term creditor might be interested in the cash ratio. For this, we divide cash divide by the current ratio. So let's go to our let's go to our let's go to our Excel to see how these things are computed. So we have our financial statement. Uh, and our if you look at the liquidity ratio, we have three ratio there: the current ratio, the quick ratio, and the cash ratio. So let's go back to our financial statement. This is our financial statement. This is our financial statement here. So those informations for current ratio, they are normally in the balance sheet. So we want to compute them. So for 2015, we'll do sheet referencing now. So this is equals to current asset all over current liability. You go to here. Make sure you don't click any other thing here. Current assets, our current asset total for 2015 is this. Divide by our current liability total. This is current liability, the total is this. So press enter, it will take you back to your sheet. So that is it. For quick ratio for 2016, this is equals to, we go back, current asset is our current asset, divide by current liability. This is current liability, enter. This is the value. This shows that for 2016, the firm has $1.31 in current asset for every $1 in current liability. So for 2015 quick ratio, current asset minus inventory, make sure you put them in bracket. So equals to bracket open, current asset, this is current asset, minus inventory, bracket close, divide by current liability. Current liability, the total is this. So enter. So this is the value. You can see in edit mode, you can see. So we can copy this because these values are close. We can copy it and we'll get the same value. You can see 1, 2, 3. If you come here now, we have 1, 2, 3. So we can copy this. You copy and you put it here. Enter. So that is the value. You can see it here. So for cash ratio, this is equals to cash. This is our cash. Divide by current liabilities. This is total of current liability. Enter. That is the value. If you copy it, you can copy it and bring it here. Enter. So that is 0.18 times. So this is how liquidity ratio are computed. So let's go back and look at the next ratio. The next ratio is the long-term solvency ratio, or what we call leverage ratio, financial leverage ratio. So they are intended to address the firm's long-run ability to meet its obligation. So this ratio are sometimes called financial leverage ratio. There are three types of them. We have the total debt ratio, we have the time interest earned ratio, we have the cash coverage ratio. The total debt ratio take account all debts of all maturity, whether short-term liability, current liability, or long-term debt. Then this take account into earning before interest and tax. So but this, because depreciation is a non-cash expenses. Is normally added to EBIT before we are able to compute the other one. Before we are able to compute the other one. So let me. So we for total debt ratio, the formula is total asset minus total equity. This will give us the total debt divided by total asset. So closely related to this is the issue of debt equity ratio, the equity multiplier. So for time interest earned is earning before interest and tax divided by interest. So it measures how well a company has its interest obligation covered. So then we have the cash coverage ratio. Because depreciation is a non-cash expenses, it is normally added to EBIT to get the cash coverage ratio. So let's go to our Excel to demonstrate how these things are computed. So in our Excel here, I have the sheet for leverage ratio. So this is the sheet where we are going to compute this. So we have the total debt ratio. This is equals to, we only compute for 2016. This is equals to bracket open total asset. So our total asset is this minus total equity. Our total equity is this bracket close divided by the total asset, which is this, enter. So it is 28% of the debt. Then the next thing we have is the debt equity ratio. Debt equity ratio, this is equals to total debt again. Don't forget we say is total asset minus total equity. Total asset is this minus total equity, which is this. So we divide it by debt equity divided by equity. So our equity is also this. So this gives us 0.38 times. Then equity multiplier is total assets all over the total equity. This is total asset, which is this, divided by our total equity, which is this. So that gives us 1.38. Now for time interest earned is EBIT equals to our earning before interest and tax. We go to our income statement is this, divide by interest. Our interest is this is our interest 141. I think there was a problem here. So we have 4.9 times. Then this is EBIT plus depreciation equals to EBIT plus depreciation we divide it by the interest. So it's 6.9 times. So this is how we compute long-term solvency measure or financial leverage. Now we'll go back to let's go back to our Excel. Our lecture, we are going to look at turnover ratio. For turnover ratio, there are normally measures of turnover. They are intended to describe how efficiently firm uses its asset to generate sales. So here we are going to look at inventory turnover and day sales in inventory. So inventory turnover is cost of goods sold divided by inventory. Day sales in inventory is 365 divided by this. The higher the ratio, the more efficiently. Then the second one is the receivable turnover. So it's sales all over account receivable and what we call average collection period, which is day sales in receivable, 365 days divided by days. So let's go back to our Excel to demonstrate how these are done. So in our Excel, this is the turnover ratio. Here we compute for 2016. This is equals to our cost of goods sold. Our cost of goods sold is this. We'll divide it by inventory, which is this. So enter. So we have the entire inventory is sold off or turnover 3.2 times. Then this is equals to 365 divided by inventory turnover. So 365 divided by the turnover, which is this. So it means our inventory sits 115 days on average before it is sold. Then we have receivable turnover. This is equals to sales all over account receivable. Sales divided by our account receivable. Account receivable is $188. So it means our outstanding credit account paid our loan the money 12.3 times during the year. So this is average collection period is equals to 365 divided by this turnover. So that is the firm collect her credit sales in 30 days. So the other type is the total asset turnover, which is the percentage of sales that are generated by total assets. So to compute this is sales all over total asset. This is equals to sales divided by the total assets. This is our total asset. Don't forget we are doing for only to 2016. So for every $1, 64 cents is generated for every $1 of asset. Then the capital intensity ratio is the inverse of this. That is 1 divided by this. So that is, it takes the firm $1.55 in assets to create $1 in sale. So the next item we look at here is the next item we look at here is the profitability ratio. So these are intended to measure how efficiently the firm uses its asset and how efficiently the firm manages its operation. So the focus of profitability ratios is normally on the bottom line, which is the net income. Here we are going to look at three ratios: the profit margin, the return on asset, and the return on equity. So the 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 profit margin, return on asset, and return on equity. So for return on equity, for profit margin is net income all over the sales. Return on asset is net income all over total asset, while return on equity is net income all over total equity. So let's go back to our Excel to demonstrate how these are computed once again. So in our Excel, profitability measure, net profit margin, that is equals to net income all over sales. Net income is this divided by our sales, which is this. So that is 15.7%. It means the firm generates little less than 16% in profit for every dollars in sale. Then return on asset, net income all over the total asset. The net income is this. We divide it by the total asset, which is this. Enter. That is 10.1%. For every dollar in total asset, the firm generates 10 cents. Then for return on equity, net income all over total equity. The net income is this. We divide this by the total equity. The total equity is this. So enter 14%. For every dollar in equity, the firm generates 14 cents in equity. So finally, we are going to look at the market value ratio. So this normally make use of information provided by the stock exchanges, the market price of shares. So the measure can be calculated directly only for publicly traded companies. If we assume the company we are using has 33 shares outstanding and the stock sold, the share price is $88. So at the end of the year, so let's look at what we can find. First, to find the P ratio, we need earning per share. We need earning per share. So to get earning per share is net income all over shares outstanding. So then we have PE ratio, which measure how much an investor are willing to pay per dollar of current earning. Higher P ratio are often taken to mean the firm has significant prospect for future growth. Then we have the price sales ratio. In some cases, will have negative earning for extended period to their P ratio are not very meaningful. So analysts will often look at the price sales ratio. So it is gotten as price per share divided by the sales per share. So uh, then we have market to book ratio, which is computed as market value per share all over book value per share. Then we have the enterprise value, which is the EBITDA. Enterprise value, which is the EBITDA. So, and this is the way it is calculated. So, let's go back to our Excel. Let's go back to our Excel to demonstrate this. I think this is the last item in our lecture. So the market value ratio, we have earning per share, which is net income all over the total share outstanding, equals to net income. Net income is this divided by the total share outstanding is this 33. So enter, that is $11. Then price earning ratio is price per share all over earning per share. Our price per share is $88. So this is equals to this divided by the $11 here. So this is 8. So it means the firm share sell for 8 times its earning, or we might say that the share have or carry a P ratio of a P multiple of 8. Then the next thing is the market value per share. The market value per share is the market value per share. So we have market value per share is $88. Then we have book value per share. To compute book value per share, this is equals to the total equity. If you come here, the total equity, which is this, divided by the total equity divided by the number of shares outstanding. That is how we got the book value per share. The total book value per share, yes. So this is equals to market value per share. The market value per share, the market value per share is $88 divided by the book value per share, which is this. Enter. So this is the value. The value of 1 could mean that the firm has not been successful overall in creating value for its shareholder. The enterprise value is total market value of stock. The total market value of stock, this is market value of stock. The total market value of stock is equals to 88 multiplied by 33 million. We have this book value of all liability. This is equals to, we go back, our current asset plus current liability plus long-term debt, this plus this. Then our cash is equals to, go back and take it, our cash is 98. Those are the value. So we want to get it, we say equals to this plus this minus this. So that is the value. Then the EBITDA ratio is enterprise value, which is equals to this divide by, we open bracket, EBITDA is earning before interest, tax, depreciation and amortization. So we take our earning before interest, EBIT, we add depreciation back to it plus depreciation, close the bracket, enter. So this EBITDA ratio is 3.93. So that is our market value ratio. So finally, if we go back to our profitability measure, we have a relationship which we express here, which we call the DuPont identity. The DuPont identity says that return on equity is the same as net income all over sales times sales all over asset times asset all over this, which is profit margin. That is our formula for profit margin, times total asset turnover times total asset turnover times equity multiplier. So profit margin, let me take the formula. We have profit margin times total asset turnover times equity multiplier. So let's go back and demonstrate that last, and that is the last thing in this video. So if we come here, our equity multiplier, let's go back and take our equity multiplier. I think we computed equity multiplier. Our equity multiplier is 1.38. Our total asset turnover is 0.64. Our profit margin is 15.7%. So they said this is saying that our ROE is going to be the same as when we take the multiple of this. So let me demonstrate. Let's go back to where our ROE is. So this is our ROE, return on equity. And this is supposed to be our ROE, not return on asset. So this is our return on equity. So let's see. That means if we have 15.7, we have 1.38, we have 0.64. So let's multiply and see. This is equals to this times this times this. So, and approximately, if we approximate this, this is truly 14%. So this is truly 14%. This is truly 14%. So this will truly give us 14. So that means the DuPont identity is correct. So thank you very much. This is the end of our lecture for working with financial statement. So thank you very much.